Hello, my dear friends. Welcome back. Inshallah, you're having a wonderful day. Today, we're going to be talking about a very simple concept, but it is a chapter two of our key performance indicator series, which is the KPIs for a Saudi CEO. It's using financial data analysis and business intelligence. It is these two things, data analysis and business intelligence, have become a very important part of any CEO's life, let alone be in Saudi Arabia or in global markets. The first question that comes to mind is why use financial data science and business intelligence? Well, the simplest answer is the correct answer, which is for performance management. So think with me out loud here. It's been 6 months. You've hired a team of individuals. You don't know if this team has the capability of delivering the profitability that you're looking at. It's does this team have the capability of producing? Does this team is it the right team, for example? These kind of questions would come to any CEO's mind looking at profitability, looking at performance management. I want to know how is my team doing. I want to know how are these departments doing. Performance management plays a very important role in any organization's ability to produce profits. While you're looking at profitability, there are only two ways that you can affect your profitability. Number one is by cutting costs. Okay, if you're earning 10% net profits and you want to increase them, for example, over the next quarter, one of the roads, the avenues that you can take is by cutting costs. So your net profit this quarter is 10%, you cut your cost until the next term, and that money that you save actually is reducing, becoming more efficient in your product or services that you deliver, and your profitability next quarter could be higher than 10%, maybe 11, 12, whatever it may be. The second avenue that you can take is by increasing sales. All right, increasing sales is any CEO's wildest dream, which is having a team which delivers more than what's expected. So, looking at these two avenues, cutting costs, for example, it has a couple of things that you need to keep in mind. It tells you the organization's efficiency, how efficient you are. It gives you an idea of how efficient your staffs are. It gives you an idea on what is the cost of the product or the services that you are delivering, and it gives you an idea on your operational costs. You have to keep in mind all of these things where you can either cut costs and increase your profits, or the other avenue was increasing sales. When it comes to increasing sales, you're looking at the business development capability and its efficiency within your organization, obviously. You're looking at the product and the services themselves. For example, an iPhone. It's an iPhone is a product of Apple. The product itself sells itself. It has its own market. People who like to use Apple products come back to Apple products without asking any questions. So it also depends on the product and services that you are delivering from your company itself. It talks about the market dynamics. Increasing sales, you must understand your market. You must understand your competitors within your market. And you must be able to understand how well or where are you placed within that market with your product and your service. Okay. Um, Another question comes up to mind. So, what are the actual KPIs that a CEO has to keep in mind? There are many different KPIs, as there are many different kind of management styles of every CEO. Okay. Global best practices, actually, they talk about 10 KPIs. We are going to talk about five KPIs here today that a CEO needs to efficiently perform his job. Okay. Um, let's look at number one, which is revenue growth. Revenue growth, the formula for revenue growth is very simple. It is current revenue minus previous revenue divided by previous revenue. It'll give you a percentage. What does it tell you? See, it tells you a direct relationship with the organizational ability to grow within its market. So if you have a revenue growth percentage which is increasing from month over month, quarter over quarter, every 6 months, your revenue growth is higher than the previous quarter or previous half of the year, it is a direct relationship that your company is doing well. Okay. It's one of the most essential indicators to measure your own success. All right. It gives you an idea on how well your company is doing. Number three, a consistent growth indicates that the business is moving in the right direction. So you may have a month by month or quarter by quarter growth rate, and you're showing that your revenues are growing every quarter or every month at a higher level. So that gives you that you're moving in the right direction. Point number two, profit margin. Net profit margin, the formula for that is a simple one actually. Net income divided by revenues times 100 gives you a very important indication of your financial health of your organization and its profitability. It indicates the efficiency of your organization's management. How efficient is your management of your organization? It also tells you how efficient you are in managing your costs. If you're very efficient in managing your costs, your net profit margins are going to be higher. It also indicates management's ability to generate revenues. It gives you a very good indication of if my management is doing a good job or not. Number three, most of the CEOs, honestly, regardless of how they were hired, regardless of what shahadat they may carry, regardless of how many years experience do they have, my personal opinion, they do not understand the impacts of earnings per share at in their organization. If the organization is a publicly listed company, if you are a privately listed company, meaning you have private investors, if you have sold shares to, earnings per share and understanding what impact earnings per share has on your organization is a key performance indicator. It is a key KPI that a CEO must understand. How does it impact my money which is available to me at my fingertips, and how does it affect my organization? The formula for it is very simple. Net income minus preferred dividends, if we have given any dividends out, divided by the number of shares outstanding. Um, what does it indicate? It indicates how many investors and shareholders can you attract. Okay. It is a very important KPI that most of the investors and shareholders look in the market to be interested in your stock or interested in your company or give an indication. Of course, the higher one obviously means that your financial performance is amazing and it will end up attracting new investors to begin with. Number four is a very important one. It is, again, one of those KPIs which a lot of CEOs do not care about or wonder about, which is CAC, customer acquisition cost. Whether you're public, private, governmental, privately owned, publicly listed company, privately listed company, this is a question which is going to be asked by any intelligent investor before they come into your company. How much does it cost for you to get one extra customer? The formula for that is unbelievably simple. Your total marketing and sales cost divided by the number of new customers acquired. What does it show you? CAC helps a CEO understand the efficiency and costs associated with acquiring one new customer. If you are an educational institute, how much does it cost me to get one extra student? If you are hunger station, how much does it cost to get me one brand new subscriber to my delivery services? Whatever you may have it. If you are a governmental institute, how much does it cost for me to service one extra new customer that walked into my office? The lower the CAC, that means the company is getting more efficient. Meaning that the low month by month, quarter by quarter, every 6 months, If you realize that your CAC is going lower from one month to the next month, it tells you that you're doing something right because it's costing you cheaper every time to get one extra new customer. Fifth one is unbelievably important, and it is something that every CEO's heart and soul thinks about, which is the customer's lifetime value, CLV. I don't know how many CEOs think about that while they are in their daily lives, but a customer's lifetime value, simply explained, is how much money can you make from one customer and how long does he stay with me on an average basis. Okay. Formula of that to calculate is very easy. By the way, accountants will most probably not know how to calculate these KPIs that I'm telling you about. It has to be a financial data scientist or a business intelligence person who can do that for you. The formula of that is average annual revenue per customer multiplied by the customer's average lifespan minus your CAC, your cost of one additional extra customer from number four. What does CLV indicate? CLV is a key performance indicator of customers' loyalty and shows your long-term customers how long do they stay producing revenues for you in your company. A CEO has to work his hardest to increase the CLV of his customers, generate revenue streams so that their customers can over and over and stay longer in their organization, and ensure that his or her customers are highly satisfied for a longer term growth and profitability of your company or your organization, though be it private or public. With that, my dear friends, thank you for attending this short course. Please do not hesitate to give me a call. My contact details are here, and please do subscribe and support the channel. We are all working towards educating and creating our next Saudi habits. Thank you. Have a wonderful day and see you again. Salam.